Again for the Wise Wealth Wednesday. It's probably like episode 250 or so. We're going to talk about the financial collapse, and a lot has changed since last week when the markets were rallying and there was a whole discussion about, potentially rates going higher for longer. And then the dominoes that I've been talking about started to fall. And the first of many of those dominoes fell, and that was three US banks, one of which, SVB, Silicon Valley Bank, was the second largest bank to fail in US history. So that was a bit of a surprise. What happened there? Let's unpack it for a second, then how it applies to your real estate investing journey, like your properties, if you're looking to buy properties, your business, your stocks. Let's talk about the implications for that and what I'm doing and acting accordingly with that. So today's a beautiful night, so I just figured I'd come out here and show you guys the backyard here, and just the Florida vibe. Just a beautiful night, so I couldn't not be outside. Okay, so what happened? Basically, the bank takes deposits, right? And they park those deposits in what's supposed to be really, really safe asset classes. What they should do is match said deposits to, the timing in which they're going to be getting it back. What they didn't do is that they put it in, effectively they listened to the Fed. And the Fed at the time in 2020, 2021 told everyone, in Canada and the United States, said, hey, borrow as much as you can, lock your money up. Rates are going to stay low for a long time. You don't have to worry. And then they printed a ton of money. And of course, that led to inflation running wild. And now we're in the rock and hard place that I keep talking about for the last year, where they collapse the financial system, they collapse the economy, and they slow growth to the point, while at the same time trying to punish people into stopping the spending. So it's like, on one hand, if you keep spending, you are going to drive inflation up. So what they have to do is try to get in between these two. And they were actually winning the war, so to speak. I guess they were focused on disinflation, which doesn't fix any of the inflation we've just had for the last 2 years. They're like, hey, we're going to accept that everything is 20% more expensive. We're never going to fix that. If you're on fixed income, we don't care. We're going to go through the disinflation, not deflation, disinflation path. And disinflation is basically, we're not going to fix any past inflation. We're going to try to get inflation back down to 2%. So your money is just losing value at around 2% every year. That's our goal. That's our target. And, Jerome Powell at the Fed is like, we're very serious about that. And he gives us this tough talk. And I think it's very possible that he may have to pivot. And it might not be his decision. It might not be entirely up to him whether or not the pivot happens or not. So that's something we're going to be watching on March 22nd, guys. Something to keep an eye out for. It's going to be interesting to see if he delivers. He's giving us another hike. He said multiple rate hikes. Whether he pauses for one meeting and says, hey, I'm going to keep rates where they are because I don't want to collapse the current financial system. Because again, remember, people, if you take out a bond and you borrow, you say, hey, I'm going to do a 1.5% return. This was like a year ago, 2 years ago. That was the commonplace because rates were like 0. So you get a 1.5% on your money over, every year or whatever yield. If for some reason rates spike to 7% or 6%, which is, they're 5-6% right now, 4 to 6% right now. They've fallen quite a bit, actually. We're going to talk about that in a second, because we've seen over the last 3 to 5 days a huge drop in bond yields, which means mortgage rates are going to drop. Not for long. I think if anything, this is a good time to refinance or lock in debt, because it's coming back up. This fight is not going to be over. Unfortunately, they don't have the tools to keep inflation down without destroying the economy and the banking system. It's a socialist banking system anyway, and we'll get into that in a second, because they just get bailed out. Every bank that fails. Credit Suisse now is on the verge of also failing. They would be the largest, I believe, and much larger than SVB. I think they're like 400% bigger. And they're on the verge of failing. I'm sure the Fed will just step in and bail them out too, because it's socialism. And what that encourages is all the bank managers, hey, take a lot of risk, guys, because even if you screw up, we're going to bail you out. And if you swing for the fences and you succeed, you take massive risk, invest in startups with no proof of income, and invest in businesses and real estate at a high risk profile. And it doesn't matter if you mess up, because we're going to bail you out. If you just mess around with the depositors' funds and you lose it, it's okay. We're going to come in. Big Daddy government, taxpayers going to come in. We're just going to tax everyone. We'll make it all better, because our system's strong. We believe in the US dollar, and everything's going to be okay. Kumbaya. It's a little oversimplified there, but for real, that's where it's at. And so I believe Credit Suisse will get bailed out if they're they're talking about having some real issues. But back to that example. So if you had a 1.5% yielding bond and bonds go to 6%, that bond, if you have to liquidate it now, you'd think, oh well, you know, treasury bills, T-bills are super safe. No, if the bank has to now liquidate these treasury bills in the open market, when they can get 6 right now in the bond market, they can get 6-7% really easily for super AAA grade quality bonds. It's really hard to sell your bond for 1%. So you have to offer a discount and say, hey, I lent $100 on this bond. I will sell this bond for $95. I will take a 5% loss, which can be astronomical when you're talking about billions of dollars of people's money trapped in these types of bills. So that's an oversimplification, but that's basically what's happening. The higher the Fed cranks, the more pain the banks have, because the banks were forced by regulation to buy government treasury bills at 1% and 2%. And they were doing exactly, you know, what they were told to do. Some of them, like SVB, have taken too much risk, and that's part of the problem. They don't have the proper liquidity reserves to match their deposits, and when there's a run, they can't cover. So when they run on the bank, then they can't cover. So that's something to kind of think through. I've done amazingly through this. You guys know that I'm short. I shorted hard into Friday and Saturday, and I did really well. Then I closed them out, and I enjoyed being neutral through the long rip up, and I re-engaged my short again today. So we will see how that plays out. I don't know. I just like it as insurance. Like, you know, if everything collapses, my brokerage account's going to rip up while the market falls. If it doesn't, no big deal. I have a huge real estate portfolio and I have a dividend portfolio that I invest in too. So a lot of my net worth is wanting the market to do well. I want rates to come back down. I want real estate to soar. You know, I want crypto to come up. I want, you know, my dividend stocks to come back. Like Suncor today, all oil and gas stocks, like oil stocks were plummeted. Suncor dropped 11% today. Bank stocks just hammered. So a lot of that on one of my portfolios, I'm nibbling all that stuff because it's like I love those plays long term, and I think there's a huge, you know, oversold territory, at least in the short term. So I'm just nibbling that stuff. But in my other brokerage account, my trading account, I'm definitely short the market, and I think that's going to pay off. Black Swan events tend to pay off 10-1. It's a great book if you ever want to read into it. But let's talk about real estate and how this affects real estate. Alberta is calling. Hey, David, how you doing? Alberta is something that I'm interested in because, again, I have a lot of Canadian dollars currently, and Alberta is a lot like Florida in the sense that, well, it's not warm like this, that's for sure. But, you know, in a lot of ways it's similar because you've got that more relaxed landlord-tenant board, more relaxed tenant rights for landlord in favor of landlords, meaning you can jump the rent up when you want. Eviction's much easier if someone doesn't pay. Also, Alberta has much lower tax rates. Their active business tax is 5% on corporations, whereas Ontario it's like 12.9%. So it's about 2.5 times the tax rate for corporations in Ontario. So there's a number of reasons why setting up in Alberta and setting a corp up in Alberta and being an active business, buying, flipping, turning around, Airbnb, whatever, in Alberta can make a lot of sense. There are some disadvantages for that economy in that, well, for one, they're very tied to commodity prices. So things struggle when oil is low, and long-term oil seems to be, there seems to be a big push from the climate activists to phase out, you know, oil and gas. So where will that play out? I don't know. I'm still bullish in the short term, but I think long-term Alberta has some challenges and struggles, and it's part of why Alberta didn't grow massively over the last 5 years. They haven't seen the crazy appreciation that Ontario saw. They aren't getting the same immigration, and they aren't getting the same trends that Ontario was getting from a bullishness perspective on the real estate. But the cash flow is fantastic there if you buy smart. I don't know about Calgary, but Edmonton has some really great cash flow from what I'm seeing. Some of the tertiary towns have some pretty good cash flow, similar to smaller towns in Ontario. So yeah, cool comment, David. I'm always looking. You know, if the right deal came across my desk, I would probably fund it. Brandon says, looks beautiful. Thank you. Yeah, it is beautiful, and I want everyone to come down here and enjoy this. So if you want to come down here and check it out, let me know. I would love to host you. We've got a few Airbnbs coming online soon in Florida, so if you're interested in that, hit me up. I also have a property that we're just finishing flipping. It's about 25 minutes from Disney. It's in Kissimmee, and it's basically a 5-bed, I think it's got to be between 2,500 and 3,000 square foot house, a huge bungalow. And we just redid the whole thing, and we're selling it for $299-ish in that range, if there's no commission. So if someone wants to buy that off us, let me know. Otherwise, it's going to hit the market, and you're going to have to pay like $330. So a little discount there if someone wants to pick that one up. It would be a good little Airbnb. You could easily do over $100 a night, so it's well over 1% rule. Yeah, nice little clean little property with a new roof and well renovated. So hit me up if you want to pick up that flip off us. We may end up just keeping it. I haven't decided yet. We could just throw it up on Airbnb and keep it ourselves. But I'm always looking at more opportunities, and I have properties coming across at 200 grand coming across the desk, and it's like, well, it's hard to hold something at 300 when I can get something at 200. And so I just like to churn real estate. But I get that most people who buy real estate buy and hold it, and they don't want the aggravation of having to go through all the effort with closing, with negotiating, fighting with the title companies, and all the renovations to get it all ready. And so there's some value definitely in buying turnkey too, especially if you're a busy individual who doesn't have the experience. William says, evening Mike, interested in your view on Schwab. I haven't done a deep dive into that yet, but I think that there are some continuing challenges in the whole financial sector. We're going to see some continued challenges in the next few weeks. I think that there's a buying opportunity for Canadian banks. I think there's a buying opportunity. I don't think the contagion will. Well, okay. So there is potentially some follow contagion, but not a lot. And Canadian banks are backstopped by the government. They really are too big to fail. Like you could buy the top 4 banks in the U.S. and I think you'd be just fine. They're too big to fail. As in, like, the government will step in and protect shareholders, even at that point, is my belief, for some of the big 8 or big 4. But the other banks, I mean, I don't know. Biden could easily, if you're investing in a smaller bank, could easily come in and say, hey, forget the shareholders, we don't care. Let's protect the deposits. So that's what they did in the first bailout, right? David says, did you look more into Addy Invest? I haven't looked into it at all. You have to send me some information on it, and I'd be happy to take a look. A lot of people send me messages, so I lose track of all the messages that come in. So you have to send me that. I'll take a look. Benefit Studios says, do you feel okay having large sums of money in Interactive Brokers? I do. Interactive Brokers has trillions in capital, so I feel very secure. And furthermore, like, again, your capital is on the the New York Stock Exchange or the NASDAQ. You own securities in underlying companies. Like, I own the NASDAQ as an example. I'm actually short the NASDAQ. I have longs too. But as an example, like, if Interactive Brokers, it won't. They're massive. But if they ever failed, you still have your underlying securities to those companies. Like, if you own shares in Apple, you would just get the shares brought over to another brokerage. Like, your money isn't gone in that sense. Yeah, it's a lot less risk. It's like being in, a big 4, and they're not using small regional banks, and they're not taking huge amounts of risk. Their bread and butter with the trading accounts is designed really around making money on trading fees, right? They're not taking inordinate risk. So no, I'm not largely worried, but I don't have a lot of cash. Most of it is like fixed in money market funds. Like, it's not just sitting there doing nothing. I have it parked in something. It's always parked in something, making me a 5% yield, whatever. When I'm between stock plays, I'm still making something, and it's parked, somewhere safe. And these large funds are not like, we had if you guys were watching, USDC, the stablecoin, not USD. USDT is the good one. USDC is the shit one. But USDT is, I only keep my stuff in USDT. But USDC, it had, I think, a portion of their cash was in SVB, and there was a risk there. And we actually saw it was a good buying opportunity, really, if you had the risk appetite. We saw that it's pegged to the US dollar, right? It's it's a virtual token that mimics the US dollar effectively, right? You'd use it to go in and out of different cryptocurrencies as a middle ground. And that token, they had a bunch of cash in SVB, and so in other banks as well that were a bit more risky in nature. And I think the challenge there was the fear of losing your deposit. And I haven't checked it, but it's probably bounced back to par. But there was a buying opportunity of 8% discounts. So you could have got in there real quick on USDC and then flipped over to USDT and made like an 8% yield in one day. That's like 1,000% return, more than 1,000, a couple 1,000% return annualized. So that was an insane play for someone. I posted on my stories if anyone was super keen on that, could have taken advantage of that opportunity. I had a feeling that the government, and they've now shown us multiple times over, that the government will basically just prove to be a socialist entity that will backstop. They pretend to be capitalist, but they will literally backstop and protect, at taxpayers' expense, any mistakes that the capitalists make. It would be nice if we had a true capitalist economy. I would love that. It'd be great if people who, like, when you put your money in a bank, you do due diligence to make sure that that bank is not taking big risk with your deposits. That's part of capitalism. And if you don't do that research and you're stupid, you get punished. In capitalism, good business practices and being an astute investor is rewarded. And those people who take high risk and don't plan for the future, they get slaughtered, and rightfully so. And they get gobbled up, and then like someone will buy up SVB, and some of the deposit money would have been, probably most of it would have been returned. But it's it's part of capitalism. Unfortunately, we have the worst of both worlds, right? Like we have like this in between where like, they're all about the people, but then we run. It's capitalist. It's not really capitalist. A free market would allow the punishment to come in. You wouldn't bail out with taxpayer dollars. You wouldn't go in and bail out. Interesting stat, by the way. I wanted to throw it up here, but I didn't get a chance to do that. I had it on my stories. If you go on my stories on Facebook or Instagram, you can find it there. There's a post of the balance sheet of the FDIC that insures all deposits. And it's something like, I can't remember the fact off the top of my head, but something like, they have like 125 billion in assets, securing trillions in deposits. So it's like a 1% cover ratio. Meaning if FDIC actually had to insure all the deposits up to 250,000 that they actually insure, they're 100 times levered on what they have, which means the government would have to come in and find the money. Where are they going to find the money? They're already running huge deficits. They can't even pay the interest on their debt that they have. As rates continue to hike, it's becoming a larger portion. It's actually a bigger portion right now than healthcare in the United States. Just servicing the debt from previous deficits, and it's growing like astronomically. It's a runway train headed off the rails at some point, and it's scary when it happens. Hopefully, more likely than not, it will continue to be kicked down kick the can down the block for another few years. That seems to be the current approach, and most societies that have failed in history were able to prolong that failure for quite a while. Typically, it results in war. That's a typical, one of the two or three main outcomes is war, right? And so hopefully the U.S. continues to invest in their arsenal, because that's the only thing defending their dollar when they have no growth behind it, and they've levered up to the tits, right? It's like, oh, if you're stronger than the bank can't take your house, right? Like imagine if like literally the U.S. government, like if the debtors come to collect, like China, I think holds a good portion of the debt, and there's many other countries as well. It's like, good luck collecting. How are you going to collect if they default? Anyway. Bow, bow, bow. Next question. Thanks so much for your suggestions regarding the infinite banking using whole life. I've been talking to different brokers, and if structured properly, it can really set your family up for generations. It can. I mean, Benefit Fitness Studio, it really is a great product for the right fit. Where it made sense for me was on the corporate side. You can really use whole life on the corporate side to insure employees and build up really nice tax-free savings accounts, and it can make sense where your tax rate's high enough. I'm eventually planning to become a tax resident of the Bahamas, so for me, it doesn't make sense to do a big policy like that. Again, because I'm going to a nation where the tax rate's 1%, and so the savings is 1%, and the cost of insurance is quite high, actually. They drag on your portfolio. Where it can make sense, like if you had a huge portfolio or a huge net worth like I do, and you wanted to get like a really nice whole life insurance policy, they actually pay like 1 year's, I probably shouldn't say this, but like between me and you guys, I used to have my LOQP, so I know what like companies in that industry pay in commissions, and agents that sell that whole life product get your first year commission goes to them, your first year premium, your entire premium. If your premium's $100,000 every year for 10 years, they get the first $100,000 goes to them. As an agent, if your first couple deals, you get a huge commission bonus too. So it's like, if you go get your LOQP, it's super easy. It's like a few months studying. I got it in like a month, I think. It was super easy. I don't have it. I'd have to renew it, but I could sell myself a whole life investment policy where I could get the first year's premium is paid for, in which case the cost of insurance versus the tax loss, or the tax shield, I guess, tax gain, is like, that argument's super easy. It's hard though for someone who's maybe, just buying with an agent. That agent's, taking there's a lot in premiums you pay for the benefit of insurance in case you die. And in those situations, it can be a toss-up. Is kind of the nuts and bolts of it. And be careful, because different companies offer different things. Like Manulife, as an example, is notorious for underperforming. It's nice that you can't be sued too. It's a nice thing from a trust perspective, or from a liability perspective. They can't garnish it, they can't sue it, they can't take it. You could screw the world over, and if money inside that policy that's invested in those policies is there for your beneficiaries, you can borrow against it, but they cannot take it, they cannot seize it. So it's a pretty cool asset class in that respect. If you're at the top marginal tax bracket and you plan to stay in Canada or the United States, it can be a great tool. Once you've maxed out your TFSA and your RSPs and you've maxed out your registered vehicles, it's the next best thing before you go to like an open margin, just a margin account or an open account. It's a better waterfall place. Like as your money falls through the waterfall, it's a bucket that I think should be filled up for most people. That's not true. For 95% of people, don't get whole life insurance. It makes no sense. But for the top 1%, probably like half of the situations, it can make sense to do it. If you don't plan to go to a tax haven and you want to stay and pay the tax in Canada, it can be a good structure for a number of reasons. There's a lot of great benefits. So huge fan of it. I think it's oversold by agents and they overtalk it up, but it does have some really good value, and I wish more people knew about it. Grinder says, hi Mike, thanks for hosting. Are you buying the big banks in Canada? I already own shares in Scotiabank, RBC, and Bank of Montreal in my dividend portfolio. They're not a huge exposure. I think and that dividend portfolio might be like 8% of my dividend portfolio, maybe less. So that sucks. Like I have a couple $100,000 in bank stocks, and they've taken, I think Bank of Nova Scotia is down like 10 or 12% in the last month. So that's a pretty big hit for that dividend stock. They only pay like a 6-7% yield, I think, currently. Maybe it's higher yield now because they've fallen a bit. But long term, I feel really good about it. The only thing that really kind of stopped me from buying more today was the fear that a lot of these big five banks in Canada, though their deposits are safe and they're backed by the government, from a real estate perspective, Canadians are very levered up. And most Canadians in the last 2-3 years, over 50% got variable rate mortgages. And almost all of them have reset. What that means is that their payments are double. Unlike the US, where you have 25 and 30-year fixed rate mortgages, we have like 5-year fixed rate mortgages, 2-year fixed rate mortgages, and most people are on variable. So in Canada, the average person is suffering to a much greater extent than in the US. And not just that, but like all the fixed rate mortgages, 20% of every fixed rate mortgage comes due each and every year. A little bit more than 20% because people fix for 2 years. And then, so what you have is like in 2020, people locked in for a 2-year fixed. That's come due in 2022. They're at a new high rate. Or they locked in a 3-year fixed in 2019. And that came due in 2022. Or they put a 5-year fixed in 2019. And now in 2024, in January, they're going to have to renew. And it's going to go from they locked in at 2.5%, 3% to 5%. Right? So that's going to be a shock to the system. And so the default rates eventually will come up in Canada. And that will affect the bank's book of mortgages significantly. Because they currently have a 1% default rate. A 3% default rate would be almost insolvency. For some of these banks from a liquidity perspective. The government would have to step in and bail them out, or they would have to figure out, I think they're already trying to shore up now and find credit default swaps and things to protect themselves, but it's, insurance only protects so far, right? It could be messy. There's a real tail risk. And so I think the upside is probably not worth the downside, but I haven't thought it through all the way. For me, I think there's better things to invest in than the bank stocks. But I have exposure. I do believe there's some value there, and I like them. They're quality plays, and I like that the government basically will step in. As they've shown time and time again, will step in and bail out as needed. Baker says, how would one negotiate for a mortgage with a bank with having no personal income within the last year, but has good credit score and is sitting on a large sum of cash? Baker, the challenge there is the banks, at least in Canada, in the US you have lots of options. There's 1,000 lenders, and some will lend you no mortgage, no income, no assets, whatever, they don't care. So in Canada, I know I'm more practiced in Canada, so I can speak more freely to that, especially specifically Ontario. There are stress testing rules where you need to have certain debt service requirements in order to get a mortgage. So for a typical residential mortgage, they won't help you out. There are exceptions to that though. If you took that pile of cash and you went over to private banking at BMO, Scotia, TD, whatever, the big five banks, and you said, hey, I'm gonna open a brokerage account. BMO, as an example, all of the banks have this, but they have a private net worth lending division that is allowed to sidestep or skirt past the debt service stress testing rules in Ontario. They don't apply to the rich. So if you're rich and you're looking to buy a property and you can show, say the property's $500,000 and you have $1 million in cash, they will make it look like if you have every dollar you have over the mortgage amount they need to borrow in excess of that mortgage amount, they will count as $1 of income. So you can basically qualify, like that was how I was able to qualify without, I have on my personal house a $2.1 million mortgage. The income I would need to service that is like probably 700 grand or something. And I don't always show that much income, right? Again, because they don't use capital gains as income in Canada. So if I show $1 million capital gain, they show me as zero income. $1 million capital gain, zero income. They don't allow to count that at all. So for me, it's a challenge. It's like, after all deductions, how much do I actually show in active income? And I don't know, I think I show like $250,000 or something in actual income. So I didn't debt service that with my rentals and stuff. It was a challenge in this current environment to debt service. And so I was able to use excess cash and investments to sidestep those rules and still get qualified. So yeah, definitely look at the high net worth program mortgages that exist. They will use cash and investments. Another option too is just take that cash, go open an interactive brokerage account, or go open even at private banking, you can open a stock account and borrow against it. They'll give you a line of credit pretty easily against that stock investment. They'll secure against it. Against bonds, they'll go 90% loan to value. Against blue chip quality stocks, they'll go 70% loan to value. Sometimes 75%, depending on which stocks you're looking at, which collection of stocks. But you're averaging like 70%. So if you had $1 million, they give you a line of credit for 700,000 pretty much automatically. So you can just take your $1 million in cash, put it into a stock portfolio, which is not a bad idea given the market's sold off 10, 15% off the highs, 20% in some stocks more. You could buy a collection of stocks at a discount, enjoy that further appreciation. Don't borrow the whole 70% because you don't want the margin call, and borrow say 50%, 40%, or 400 grand, and go buy a house. There you go. And now you can deduct that interest too, so it can be a win. But yeah, there's lots of ways to skin the cat. You can definitely still get mortgages. It's not impossible for sure, both in Canada and the US. Especially with good credit, that's important. Port City says, NGL in the US is just another example of crony capitalism. The average Joe, if he makes bad investments, will get hung out to dry. If you're a regional bank and make bad investments, you will get bailed out. And that was what no one was sure about, right? Like over the weekend before they came on TV on Sunday and were like, hey, we're having an emergency meeting. We were not sure, right? It's like, will they bail out regional banks? And so now everyone's scared to put their money in regional banks. Well, not anymore, I guess, because the Fed came out, basically said unlimited. Like FDIC used to insure 250,000. Now it's unlimited. So I mean, it's like obviously they have no limit to what they will insure. That word, if you test it, won't back test well if if the Fed continues to raise rates. More collapses will come, and the result of that will be more pain, and the FDIC doesn't actually have the assets to protect all of those deposits. And so then either they tax the hell out of the banks with fees, which will take a while and they can't do because the banks are already struggling, or they take it from the taxpayer in the form of a deficit. And so that's realistically the taxpayer pays it. And so now that you need to wonder, in the United States specifically, where is it going to come from? Where's the revenue going to come from? When you are crushing every asset class for the American person, where their crypto's down, their real estate's falling, their stock portfolio's falling, their dollar, soon probably will correct from where it is now. We're in crazy times, so other countries are suffering as well, and the U.S. is, in times of war, a very strong currency, typically. So it's unique times, but I think that they're going to have to raise tax rates. And Biden's proposed taking the capital gains tax rate from like 20-something% to 40%. So that's a double. If they're going to tax you $250,000 on a sale of a $1 million building, it's going to be like $500,000 now. That's double the tax bill. That's astronomical. That's huge. The rich already pay the whole tax bill as it is. If you make like 40, 50 grand a year, you actually take more from the system than you give, especially in Canada. If you make less than 80 grand a year throughout your life, you actually take more from the Canadian system than you give. So I know people complain about tax, but like the average Joe you're talking about, I mean, they don't contribute, take all to the overall system. They take more than they give, sadly. So yeah, I would say it's challenging times, right? I don't know. The US is a beautiful place, and it has one of the better systems in the world. It's not the best. It's getting worse, I would say. But compared to some other countries, it's still a desirable place to be. It's still, it has a lot of strengths and a lot of pros. And so I don't want to hate on the U.S. economy and I think they're under bad management right now. I would love to see a Republican win. It was nice to see the switchover more recently. I don't know. Canada also could use a clean up house. it would be really nice to see that. But I'm gonna go where I'm treated best, as Nomad Capitalist would say. I'm gonna go to the Bahamas, and I'll still be in Canada, I'll still be in the United States, but only to come to do business. And I'll pay tax on what I make in Canada and the United States. I won't pay tax on income I'm able to derive from, say, a mastermind that I throw in the Bahamas, or any stock investments that I make from the Bahamas. I will be tax-free. And that's where I'm gonna go. That's where I think many rich people and wealthy folks are shifting to. And so I'm sure they're gonna clamp down on that. I gotta get out now while I still can, because they'll probably put some sort of rule in place where I can't leave, but it's so expensive to leave that. As an interesting aside, if you're going to leave a country, there's an exit return. You pay a big declaration of all your assets, and you mark them up to fair market value, and you pay tax on them. So it's expensive to leave. It's treated as like you sold everything. So one thing I'm thinking is, during a recession is a great time to go, because the fair market value of all your assets is artificially really low, and so your tax bill to leave is pretty low. So if the US dollar would drop and the Canadian dollar would gain some strength, I'd be pulling out more. I'm waiting, unfortunately. I would love to get money out of Canada, but I don't want to shit on Canada at the same time. Like, Canada's a beautiful country. My cottage country on the Great Lakes, some of the freshest water, some of those beautiful scenery. There's nowhere I'd rather be on vacation for the summer in the world. Like, even the waters of Bahamas don't hold a candle to the Great Lakes and the beautiful crystal clear water. It's like turquoise blue. I should show you guys pictures. I will show you guys pictures this summer. You can go on my Instagram stories. You can view saved stories there, and you can see what it's like in my cottage. Some of the days the water is like literally turquoise, beautiful, fresh water, not salt water from the ocean, but fresh, clean, beautiful air and water. It's a beautiful country, really nice people. People in Canada, when you bump into someone, you're like, sorry. Here in Florida, I'm buying a washing machine on Marketplace, and they literally like sign a paper saying it works perfectly. We get it home, it's broken, and they block your number. Like, people are just scumbags in the US. Like, especially in Florida, from what I've seen, there's a lot of contractors just con you. Everyone's just out for themselves. And I don't know, it's pretty bad here. In Canada, you don't get that. People honor their word. They are sorry when they make a mistake. If they do screw you, like, even they're sorry doing it. Like, hey, let's like come to a compromise here. Like, I'm losing, you're losing. Let's find a way to lose together. It's like in the US, it's like the finger and that's it. They don't care. Block your number, on to the next. Screw the next person. So that's a toxic culture. Not all the people. I've met some really great people. We went to church here in Florida, and we met some really great people. Through my realtor and some friends that I have down here, we've met some really great people too. So there are really good people down here. And I love the capitalist nature. I love the hustle and the push that you don't have. Like, if you go to Vancouver at like 4 o'clock and go to like Vancouver, and you go like 4 o'clock, everyone's out of work. Like, everyone's just chilling. It's like 3:30. People are out at the bar hanging out. Like, people don't work hard. They chill in like Vancouver, or they, in cottage country, everyone's just chilling, having a good time, being kind to each other, like having a brewski. Where you don't have that, You don't have that in the U.S. in the same way. I notice people, they do work hard though. There's a lot of immigrants here that work really, really hard, and I respect that, and I like that, especially from a business. Like, when I'm running a business, I'd much rather run a business in Florida than run a business in Canada. It's a better place to do business. There's way more opportunity too. Like, there's like one hotel for sale in all of Ontario right now. Like, maybe there's like 20, I don't know. But there's 20 times that in Florida, right? So there's just so much more opportunity. It's beautiful down here. Like, this is, look at these sunsets. Like, the sun's set now behind me, but like, this is what I got to live with. It's like, we're painting the whole thing tomorrow, so never mind the patches. It's gonna be all freshly painted tomorrow. But it's like, I don't know, guys. It's just a beautiful, beautiful night. I'll go on to the Q&A here for a second and slam through some of these questions here. Alex says, how do we choose the perfect property from a price, location, long-term value perspective? So for me, it comes down to buying quality properties with good dirt. So you want a good building, ideally something that's really quality made. I like concrete block construction where you can. In Florida, in Canada, it doesn't matter as much. Concrete block's nice, but none of the houses are made with concrete block. Like 1% are like, ICF, poured concrete construction. All the foundations should be poured concrete. Like, you want to find a nice solid foundation in Canada. We have basements in all the properties. None of the properties in Florida have basements. So really the foundation is super important in Canada. Here they're all on slab. So obviously foundation is important, but buy a good quality property in a good location. Pay more money and get a lower cap rate. The more I have done business, the more I'm like, I'd much rather own in a B class neighborhood than own in a C or a D. Like I did that for a while. I owned some C and D class properties and got some real scumbags, and like they are the hardest to manage. They have the most damage. You think you get a better cash flow because your cap rate's like 12 or 15, but you net nothing because the maintenance expense and the capex expense and the management cost of maintaining these people is just so high, and the appreciation isn't as good in those areas versus like a AAA location, like a really quality A location. I don't like to buy the A location properties. I look for the B, which is like, it's a quality property. Like this is a nice, decent neighborhood. As an example, that's where we buy most of our properties, is like a quality neighborhood. I'm not paying $1 million for a house because it doesn't cash flow. I know there are people who are buying in, Miami, buying a really nice, flashy $2, $3, $4, $5 million property, or they're buying in that A plus location. It can make sense. Like there are some times where, a beachfront property can cash flow really well on Airbnb, and those can be great gems in the portfolio. But typically I'm looking at like a base hit. So from a location perspective, I don't want the C and D. I know it can be attractive. You're like, oh, look at that $150,000 house. And it's like, that's great. It looks really attractive. But once you own it, you're going to find out you should have probably just spent an extra 100 and got a $250,000 or $300,000 house in a B neighborhood. I'm just generalizing. Every area is different. Like in Toronto, you're going to pay $900,000 for a decent house, right? But don't pay 1.5 because your cash flow just doesn't make sense. So you've got to make sure you cash flow first. And so find a decent area that you can cash flow well in. So that's, for me, that's where I'm looking for. 2, the most important thing is undervalue. So I need to be able to buy it at a discount in case the market falls further. In a rising market, I still buy at a discount because I want to make more profit. I want to make sure that I can pull my capital out. Once your capital has been pulled out of the deal, like let's say you buy a property for $300,000, you put $50,000 into renovating it or whatever, maybe do Airbnb, so you put $30,000 into furniture, $40,000 into furniture. You're going to cash flow back that furniture in 2 years. You're going to be cashed out of that. But within 6 months, you can usually refi the entire purchase price out and most of the renovation. If you're lucky, you get the renovation back as well. In which case, like you got your renovation and you got your down payment, everything out, you have no money in the deal. And with cash flow, sometimes the Airbnb, you can pull out all the furniture too over a 2-year period. You can get that extra cash flow above and beyond market rents. So Airbnb is great for that because it can juice up your returns. And then your property is beautifully staged. It's always ready. If you ever want to refinance it, it's ready for appraisal. If you ever want to sell it, it's like beautifully ready. Whereas if you have a rental property and you go to sell, you got to get rid of the tenant, you got to paint, you got to clean up and redo it all. Whereas an Airbnb is always ready. Just super clean gem in the portfolio. You can get liquid much faster. Whereas a rental property takes longer to get liquid with. So that's why I like Airbnbs. I like furnished stage properties. I like that you can add some money in furnishings and get double the annual revenue. Like you have to buy 2 properties to get double the revenue typically, but instead you can put like 30, 40,000 into a property, and now you can get the cash flow of 2 properties by simply spending, 20% of the down payment. So I don't know. I think there's definitely some value. So for me, it's about looking at where the numbers make sense, looking at the long-term fundamentals too of the area is important. Demographic trends, is the city growing? Are people coming there? You want there to be a supply-demand imbalance, and you want to specifically target where that supply-demand imbalance is going to be. This is an average middle-class house. That's exactly what everyone wants. It's super easy. It can cash flow as a long-term rental, cash flows even better as an Airbnb, and it's the type of property that over the long term you would suspect that people would desire, and builders can't keep up with building enough of these. That's what you want, especially in Canada. We have a real crisis in Canada. Down here, they know how to get business done. They can build housing supply, but in Canada, they really struggle. It takes forever. The building inspections you can be a year building a house sometimes if you're doing custom stuff, from start of plans and all of that submitted to the city. It's just brutal, and it's really expensive. The trades down here are cheap. I got painters here for $150 a day, and they'll work a full 10-hour day. Where at home, I'm gonna pay like $500 for someone to come and do that. There's no immigrants at home that want to work, because in Canada, if you bring your 6 kids with you and you immigrate from Syria or Bangladesh, I'm just making up, India, whatever, into Canada, and you bring your kids with you, Canadian government's going to give you $600 cash, tax-free, after-tax dollars in your account every month per child, plus a stipend if you don't work. And if you get over $30,000 in income, they'll claw it back. So they all just keep their income low. They have no incentive to work because they bring 6 kids over, and they've got, I'm generalizing, but I do know a lot of people that are doing this. And in Canada, you're getting $4,000, $5,000, $6,000, $7,000 a month after tax. That's the same as making 6 figures. So you could work as a doctor or a lawyer, or you could just sit at home with your kids. Welcome to Canada. So there's not the same incentive that they have in the U.S. Like, you'll starve, you'll die. There is no, like, an immigrant here is just trying to get they're just trying to climb up in the world. And so I like that they work hard and they do good quality work for the most part. So yeah, that's pro. But anyway, I hope that helps. David says, or did I miss the question here? Yeah, okay. David says, senior story about opening a lot of unsecured lines of credit. Huge fan of that. Been bragging about that for years, about how every single investor should go, before they quit their job, go and get a line of credit at the same time at a bunch of different banks. All the banks, all at once. Probably got $50,000 a bank. I bet you, and you go to credit unions too and do the same thing. You probably pick out like 7 $50,000 line of credits all at once. And, it doesn't hit your credit right away. So it takes like 30 days to do it. So you could set up 7 lines of credits. I know someone that, I didn't do that, but I know someone that did do that, and they got $350,000 in unsecured lines of credits. I know someone had a really sweet job and they got $100,000 per bank. So you can get hundreds of thousands of dollars in unsecured capital that you can take and use to buy real estate or whatever you want to do. So that's amazing gunpowder at prime. Like my unsecured line of credit, well, I got lucky. I got high net worth. So when they set up my high net worth stuff, I got like $1 million line of credit at prime. So I'm super lucky that I've got that access to that. I keep it for emergency funds and I keep it there, if I need to take down a deal or something, but it's at prime. So prime in Canada is 6.7% right now. It's kind of expensive. But I guess some people consider that cheap. And when prime goes back down to 3 at some point, inevitably it will, then it's definitely going to be an asset. So I would say I'm a huge fan of that strategy. How do you get so many, or how much in dollar value as an investor? So if you go to the small business too, the small business divisions of every bank, you walk in, you ask for like $40,000 to start a business. You're a graphic design business, you need, money for whatever, or you want to renovate your house, you went for an unsecured line of credit. Unsecured is great because it's secured to nothing. So then you can go get, you can go buy property, do whatever you want with it. It's not secured against anything. So I'm a big fan of unsecured debt, but manage it safely, guys. Like, this is a great strategy if you're a prudent, good investor. If you're watching this and you're horrible with money, don't go open those, right? That unsecured line of credit is there for like really quality opportunities, like good properties that you otherwise would have had to give 50% of the equity away to take down. Like it's got to be for the special deals, and you got to be careful with it. Or if you have already an existing portfolio and you're quitting your job, I would say to you and your spouse, each you go out and get individual lines of credits. Don't apply together, apply separately, get a bunch of unsecured lines of credits. My wife and I did that. We got like, I think at the time I got like 25,000, 50,000, 25,000, 35,000, something like that. A bunch of those at all the different banks. So we each had 6 figures in unsecured line of credit. That's a runway. If we need that money for a major renovation or to buy a property, we don't need our jobs anymore. Also, another thing I wanted to mention earlier that I didn't was commercial mortgages. In Canada, more and more commercial mortgages are making sense. And commercial mortgages, the building qualifies, you don't qualify. So if you have no income, you go to commercial lending, you say I want to buy a 5-plex, they qualify the building. If the building cash flows strong and can debt service at 1.5 times or whatever it needs to qualify, it doesn't matter what you make. In the world of commercial financing, no one cares what you make personally. They care what the building can do. Part of the story is like, hey, you have experience as an investor, and that's important. Like, they're not going to lend to someone who's never done a big deal before. They're just going to say, hey, you're doing a 20-unit building, you've never done any deals before, let's go. They might have some concerns. But if you have a track record and you've done a lot of deals before, you go in there and you make the case, the building makes the case for you. So commercial financing in Canada and in the United States is all about the building, not about you as an individual. So if you don't have great income, even if you don't have great credit in some cases, you can still get a mortgage on commercial property. It's not as good loan to value. You're stuck with 70% loan to value or 75% loan to value in some cases, but it's easier. And it's also in many cases, well, it depends, but it can be non-recourse too. So it's within a corporation, you buy the property in the corporation. As an individual, sometimes you're not even liable for that debt if things go bad. It depends on the commercial lender, but sometimes you can strike that out and they're okay with it if they like the building enough. So as a real estate investor, that's fantastic because you can scale to infinity. You could have 1,000 mortgages. I know people have 100 mortgages with the big banks with the commercial lending division. So stay away from the residential. If you don't have the income, go to the commercial department. You can keep doing real estate deals forever till you're blue in the face. There is no maximum. You're going to pay a little bit more in interest, but who cares? If you can keep growing your portfolio over time, it's going to more than make up for it on the top line. With the banking showing how much of a failure it is, do you think Bitcoin is an answer? Bitcoin's jumped 25%, and I do hold some Bitcoin. I do have some holding, not a lot. I had a lot more before. I sold a lot of it off and I tax harvested. I like cryptocurrency. I like blockchain. I like decentralized finance. I'm fearful that it the government might try to create their own and boycott some of the smaller tokens that aren't as, I guess, mainstream. I don't think they'll do that for Bitcoin. I think Bitcoin will be like gold. It'll be digital gold. And so I believe in it. But some of these smaller altcoins may get treated as securities or banned, which hurt their market cap and their value. So I love the technology. Soon, not now. When we get inflation under control, when rates come back down, I think probably 2024, we're going to see a bull run in the crypto space. I don't think the bottom is in yet, though. I'm still bearish. I don't know. Short term, I'm bearish. Long term, I'm a bull. You guys know, like, I believe the market's just straight up over a 10-year period. You zoom out, it's always straight up. Like, everything goes up always. Inflation ensures that. But investors need a certain return, and it's important to them to have those said returns. So, yeah, I'm extremely long-term bullish. I would never stay short for a long period of time. Shorting is done in short bursts of time, and if you're wrong, you cut and you move on. Shorting is meant to complement your long-term portfolio. So if you have a bunch of stocks, you add some shorts to those, and if the stocks fall, you now have a bag of cash, insurance against those stocks to buy more of those stocks at a discount. It's meant to be part of a holistic portfolio strategy. It's not, I think people get confused when they follow my stories. They think that like all I'm doing is shorting. And it's like, I do have a net short position in that brokerage account, but I have other brokerage accounts as well. And I have many asset classes. My net position is always long. Long term, you will always win if you're long and you're diversified. If you own a small piece of everything, you will always win over the long term. Short term, it might be painful. Things might go to zero. But if you own every bank in the United States, you don't care if one or two fail. Because on aggregate, the whole banking system isn't going to fail. The government will guarantee that it will not fail. If your money is in a Big Four bank, you're safe. If you're watching this right now, you're in a Big Five Canadian bank, Big Four American bank, you're fine. The government will guarantee your deposits. You will be just fine. Okay, I'm gonna do some more Q&A here, and then I'm gonna wrap up the stream for tonight. Try to get to the hour mark if I can. Jazzraj says, what's a good asset mix in equities for someone in their low 20s for early retirement? Again, like I can't give you the answer to what your risk profile looks like. You have to answer your own risk assessment and find out what your risk profile is. But in general, in times of low interest rate environments, I have a 0% allocation for fixed income and bonds. My fixed income allocation comes specifically from private lending and mortgage lending. That's where I'm able to get 10% plus yields when rates are 2 or 3%. And so that's a big outperformance, and that tends to perform well over the long term. So I like that. However, I like 100% equities in that respect. However, we are in unique times. And last week, if someone would have asked me, and yields were skyrocketing on the last Wednesday stream, I'm bullish bonds. I was like, geez, like bonds seem like a play. Especially some of the AAA corporate bonds in Canada were paying like 9% yield, 8% yield. They've since crashed and fallen, yields have fallen, on the belief that the system can't sustain this level of rates with the debt service that everyone has now. Everyone's levered up to their eyeballs where they weren't before. And the price of everything is so high that no one can carry this debt at these rates for long. And so there's a pricing in the market that the Fed is going to bring, at least pause, or not deliver as much pain to us as fast. And so on one hand, that's great because, rates won't be as high. But on the other hand, inflation is going to keep running. They need to be hard on us. The problem is the system and the economy can't handle it. The people and the economy can't handle the punishment the Fed needs to give us to get inflation down. So now we're stuck in a rock and a hard place where inflation continues to run. We're now coming into year 3 of high inflation. In 2021, it started getting out of control, and they said it was transitory. In 2022, it's coming back down, guys. It wasn't. It didn't. 2023, it is starting to arc down because they've changed the calculation. If you use 1980s method of inflation, it's double digits. But they've changed the definition. And really, I think this may end up becoming a battle until 2024. So we may have 4 years of inflation. And then unfortunately, they're not going to bring deflation to fix the prices that have risen like crazy over 4 years. So if you're on fixed income, you've lost 20% of your buying power forever. That's never coming back. Prices are not going to fall enough to justify, I don't think. I think we'll see disinflation, not deflation. Disinflation is the deceleration of inflation back down to 2%, but not deflation. Deflation is also bad, so like either way it sucks. It'd be nice if the Fed could just the Fed is a different entity from, say, Congress, but it'd be nice if government, and I'm talking about like, you know, Biden and his administration and even just Congress in general, would spend less, because they spend their way into inflation. They need to control the money supply, and they didn't think through that, and now this pain is a direct result of the stimulation in 2020 and 2021. I wish I'd put my money where my mouth was. I didn't make as much money as I could have made on taking advantage of this. The writing was on the wall, you know? It's like, you can't print a whole bunch of money and expect that. The nice thing about inflation running crazy though, guys, is that our assets will appreciate. And so with real estate, like, I mean, all this 20% inflation is going to catch up with real estate. Real estate is going to have another big run where over the long term, real estate outpaces inflation in a big way. So don't worry, your assets will catch up over a 10-year period. Just don't sit in cash. Whatever you do, do not sit in cash, and definitely don't park that cash at a small regional bank right now. Park it at a big four bank or deploy it into a safe asset class, which is what we're seeing happen. We've seen stocks rally a bit. We've seen cryptos rally 25% from its, in the last like week almost, from the lows. And I think we're going to see a little uptick in real estate. We're seeing that in Ontario specifically right now, where people are kind of jumping in this spring rush. Yields have fallen a bit, so that should pass on to mortgage rates temporarily. We'll see rates come down a bit. I think it'll spike again. It's not just going to be a straight line back down. It'll be like there'll be up times and down times. It's a downtime right now. It's not a good time to get into bonds. It's a good time to borrow. The treasury yields are dropping. The bond yields are dropping. The 10-year is dropping substantially. So it can be a good time to borrow. And I think over the long term, we will see that real estate prices will come up and all the asset classes will come up to outpace inflation. It's just right now, there's so much uncertainty in the market there's so much bull energy and the market wants to run and people want to buy properties, but there's a lot of people that are afraid right now. And so until the Fed pivots, there's a lot of cash, probably trillions in BlackRock's and other funds that's waiting to be deployed. Guys like me, Kevin, who have, his whole thing, house hack. They have the cash sitting on the side. All these guys who have funds are waiting to buy. Even Grant Cardone has paused a lot of his buying. They're going to buy hard when the opportunity presents. So there's going to be a really big bull market coming. I don't think the bottom's in yet. You could start nibbling now because again, things are at a discount. But I don't think the bottom's in yet. It's hard to predict the bottom, but I don't think it's in yet. I'm going to continue to dollar cost average, which means I keep buying properties, I keep buying stocks, I keep buying little by little and deploying. I'm holding on to some, liquidity, but I'm buying because I think that before you know it, we're going to be in the next bull run and you'll have missed the opportunity of a lifetime. You're going to look back and say, Bitcoin was 15,000 USD and it might even hit 10,000 yet, who knows? But I think we're going to look in 2024, 2025, 2026, and it's going to run to 100,000. We're like, damn, that was like an 8x opportunity. And real estate is going to double. These $300,000 houses in I guarantee the next 7 years. 7 years. I'm 30 years old. I just turned 30. I'll be 37 in 7 years. I guarantee I come on here. I'm probably still doing these live streams realistically, and I probably still have like 5 followers. And we're going to look back on these streams, and I'm going to say, look, in Florida, there's houses, all these houses, they're 3,000 square foot houses, 2,500 square foot houses for $250,000. They're all going to be $500,000. Mark my words, all of them. I'm going to have a couple hundred of them. I'll be glad that I was buying them now when everyone else was afraid. Because there's a lot of fear right now. If you buy smart and you operate your business well, you will do amazing things over the next 3, 5, and 7 years, 10 years for sure. So that's my outlook. Short term, I'm a little bearish. Be careful, guys. Don't go all in. Deploy carefully. At the same time, don't keep cash either. So I know I'm giving you crazy mixed messages, but deploy it. But here's what I do. Here's how I keep my cash working for me. Oh, damn. This thing's all in screen. There's got to be a hole in the screen somewhere. Mosquito got in here. Here's what I would do. I deploy all my cash, but I continue to cycle that cash back out. So I'll do a project, but I'll sell and get more cash to continue to buy the dip. So I might buy a property for 200, fix it up, sell it for 300, and then take that 300, buy another property for 180 because the market's falling, and then sell that property for 280. But each time I'm making money and I continue to roll that real estate. So you can keep your money working without being locked in. You know what I mean? You can continue to work your money and keep it going for you. So that's what I would be doing in these times. I'd be running a business. I would be, focused on good long-term fundamentals. if you have to hold something, if you flip it and you're like, hey, there's like 20K profit here, there's no profit here, you hold it. And now you make 10K a year in cash flow. And in 5 years, you've made 3 times what you would have made flipping it, plus all the appreciation. 3 times what you would have made flipping it in cash flow, plus the appreciation. So there is a time towards the bottom where I'll be acquiring and I will be holding. I'll probably not be selling because market fundamentals won't make sense to sell. I'm looking forward to that time because that's when I want to go even harder. So look out, guys, because there will be a time I'll come to you and say, hey, we're past the U-turn moment. Rates are falling. Some point after that, real estate will start pivoting. And we can use the old comps from when things were shitty to get really good deals as the market's rising. And that's a beautiful thing because if your flip takes longer, no matter what happens, you just keep winning. And usually in real estate, you win. This is one of those short-term periods where you can lose. So be careful out there, everyone. Mad respect to the people who are still hustling through this because it's gonna pay off big time. Alan says, great job on the pool. What are your thoughts? Did you guys see this pool before? It was like a 2-inch layer of green sludge on the whole bottom and the whole top. There was frogs in it. I think there might have been a couple lizards living in there. It was the most nasty pool. We had to acid blast it. It was the dirtiest transformation I've ever had. The pool equipment was all fried. Even the motor wasn't working. We had to redo everything. This was a big job, but it's crystal clear now. It's beautiful. We're getting there. We're getting there. I turn everything to gold. Just give me some time. I can polish a turd. Sorry, the last year question was with acquiring a 5-unit building with private financing and then using CMHC MLI to exit. Definitely. CMHC offers some amazing commercial financing on the bigger buildings. You can get, in some cases, 5% down, 95% loan to value in Canada. That's what's propping up Canadian large multifamily right now, is that no one has to put any money in. And on top of that, rates are like 4% in Canada for large multifamily. That's in the US, you don't have that. The government actually comes in, CMHC, and artificially subsidizes the rates. That's what's keeping Canadian large multifamily up right now. Is like it's almost too big to fail. The government's basically subsidizing it. So I love that strategy. It's great. Como says, welcome to America where everyone's a mercenary working for the highest bidder. Como, there are people out here who are solid, but there is a lot of, there definitely is a lot of that going on. Some people are shit. Sup Dude says, market is going to fall down hard. There are no jobs, high insurance, woke schools, homeless everywhere is not a good look. Good luck to Ron, but I think a lost cause. That's a little too bearish for my outlook. I think long-term things are good and people are good. And if you look at the actual jobs data, what you see is there's more jobs openings than there are people to work them. And a lot of the business owners are looking for skilled labor and they can't find it. So there is still a challenge, and that there's a lot of unskilled labor in America. They can't find work. But there's a ton of skilled opportunities, and it's gonna get worse. There's no doubt in my mind, short term, there will be pain. When their unemployment rate skyrockets, when we have mass layoffs, they're starting. A lot of the tech has laid off and it'll move to other sectors too. It'll trickle down. But that's short term. Long term, the people will pull through. I know when things look dark and that the world's going to end, but it always comes back. And we come together as a people to rebuild society. So even when society feels like it's going to collapse, that's when you want to go long and go hard and invest in people. So now is the time to be investing in people, building your core teams, all of that. Super, super important. And only people with money can afford to live there. I mean, I have a whole channel. Like I started my channel based on Frugality, where you could live a kick-ass life working at McDonald's. 2 people working full-time at McDonald's, making minimum wage, which in Canada is like 20K a person. So 40K total, 20K a person. You can live a good life. There's rent hacking. There are so many strategies I've talked about on my channel about how to live a good life on less. I live it now. I believe it now. I'm super frugal. I still believe in house hacking. House hacking is the idea like you go and you buy a duplex. You live in one side with your family and you rent the other side out, and the other side pays your mortgage. That's a great strategy. Or if you're rent hacking, you go rent a 5-6 bedroom house in the suburbs and you rent out a couple of the rooms and you live in the other, or you find a duplex and you rent the whole house from the landlord. You negotiate something and you find a way to live for free with roommates or another unit. Rent hacking is that you don't even have to have any money. You just go rent a house and you rent out parts of the house. to other tenants. You sublet while you're living there. It's not a sublet because you live there. So you don't even need the landlord's permission because you occupy the house. If you live there, you don't even need the permission of the landlord to have family members or friends come live with you. You can do that without permissions. So there's definitely ways to rent hack and house hack and live well on less. So to that point, I think a lot of Americans don't know how to live humbly and how to make dollars stretch. I see it all the time. I see it in some of the contractors that I'm working with down here, where they'll go spend like $50 on something frivolous, and it's like there's a much better way to achieve that same result for like $10. But people don't think that way, right? So if you're watching this right now, we're an hour in, hit the like button. It'd mean a lot for me. If you hit the comments too, after when it posts, just go in the comments section for me. I forgot to post that initially, but if you find some value here, share this stream with someone else, share it on your social media. It'd mean a lot. Tag me in it if you're going to share it on your social media. It'd mean a lot. You can just do the link button on Instagram and you can literally link to my YouTube show, this exact video. That'd be cool. I appreciate everyone who's watching tonight. I appreciate all you guys for tuning in. Again, I'm long-term bullish. I think short-term we're going to have a lot of pain. That's why I have my shorts, because I believe that there is pain to come. And we need that to get inflation down. When the police officer making 45 grand a year can no longer afford to go on vacation this year, that's when inflation falls and rates come back down. And the world goes back on as it did before. And it continues to rise. Everything continues to rise over time. So just remember that, guys. It's important to be long-term focused. And you don't panic. Every situation that we go through, good or bad, is an opportunity. And you have to think, how can I benefit from this opportunity? What can I do? What can I change in my strategy to thrive coming out of this, business cycle? It's all just business cycles at the end of the day. So, yeah. How do you find properties at a discount? Some of it is just throwing out a bunch of offers on the MLS with a bunch of different agents. Some of it is talking to people off market. A lot of it is just developing wholesale connections, talking to people who knock doors, calling bird dogs. It's a lot of work on me to build that network, and I'm still building it now. But I make calls every day, and I'm building that list every day, to the point now where I'm literally getting 40, 50 emails a day right now, just on Florida deals. I can't even look at all the deals that I'm getting in my inbox. I literally need to hire someone to look at them all. I quickly go through and try to cherry pick the best ones, and then I look at those ones. But legitimately, I got like 200 off-market deals today emailed to me from probably 50 wholesalers. And it's like, there's just literally too many deals. In Canada, we don't have that much hustle. There's a few wholesalers, there's like 5 in a town. If you're looking at a few towns, you might have 20 wholesalers on your list that you talk to. You might have 50 agents that you talk to. There's just less of everything. But that's how you do it, is you gotta go out there and you gotta know what a good deal is first. Like, how do you know it's a good deal? You gotta use your eyes, you gotta look at hundreds of deals to know, how do you make this into a good deal? Because sometimes the deal doesn't appear good, but is good, right? How do you float your variable rate mortgages when everything's going up? Landlords are restricted from raising rent. I don't do long-term rentals. I like to do short-term stuff. With student rentals, things change over, so you get to increase the rents. With Airbnb, you can increase the rents to cover. Ideally, you're buying properties that you ran sensitivity analysis on. You expected that rates might go to 7 or 8%, and you ran your numbers accordingly. And if they don't cash flow, sell that property. It doesn't make sense in many cases, and not always. Sometimes it makes sense to hold it, but in many cases, it doesn't make sense to keep that property if it can't cash flow. Which means I probably won't ever own any property in, not ever, but more than likely I won't own anything in Vancouver or Toronto or LA or New York. Like, I just won't own in those metropolitans because the cap rates are so low. The yield is so bad. Yeah, it's quality real estate that might appreciate a ton, but that's not the game that I'm in. I want appreciation and I want cash flow. Cash flow reduces risk. If you could hold your mortgage is never called, you're totally safe for the long term. That's important. So making sure you can pivot in some way to be able to get cash flow. If you can't cash flow, maybe you can change your strategy. Can you turn it into student rentals by the bedroom? Can you furnish it and throw it in Airbnb and find a way to make the cash flow to be able to sustain the 8% mortgage? You know what I mean? And if you can't, then sell that property and find something that can. Because there are properties out there that can. Bum, bum, bum. I thought real estate was a lagging indicator. I'm seeing house prices in the GTA are already starting to go up. What's your take on that? So, yes, real estate is a lagging indicator typically. It takes a long time from start to finish. However, I will say this. This will be my last question for tonight. I will say that the reason that the market is kind of having a little blip up right now is rates are starting to come down, and the fear of further rate hikes in Canada is lower because the Bank of Canada has come out and said, we're not going to raise rates. We're going to hold. We were more aggressive than the US. And so initially we actually did pretty well as a country. It's just we punished real estate pretty hard. And we also banned in Ontario, we banned foreign ownership of property. So if you're from the US or you're from another country, you can't even buy single family properties in Ontario. So they did a lot of things quick to really kind of cool the market off. And the market, it reacted. It took 30% off the price in Ontario. It was a big drop. Is there more pain? Potentially. But I think there was a lot of people who were sitting on cash waiting, and those people now are starting to deploy that cash into the spring rush. My thesis is we will see another low in Ontario in December of this year. Seasonally speaking, May is the highest sale price on average. And if a market was flat and there was zero appreciation, May to December would be a 9% variance in price. That's significant. On $1 million house, that's a $90,000 difference. Assuming no appreciation or depreciation, the seasonal difference between selling in May and selling in December is a 9% difference on average every single year. So the bottom typically results in the year in December of that year. So December of this year, we'll have a pullback from where we are now. If you buy in December, you can sell in May. It's great for flipping because you get you buy in November, December, and then you sell in May, and you get a nice big exit typically. So that's what you want. But yeah, I think the bottom is either 2024 December or 2025 December is going to be the bottom for real estate. But I think in Ontario specifically, most of the pain has already happened. So we've seen most of the depreciation we're going to see. I think we might see another 2, 3, 5% decline, which is why I'm saying don't rush into things. Analyze 100 deals, throw out 20 offers. Someone's going to take your low ball because there's no other offer on the table. They'll negotiate with you, and you might be able to buy a property at 2025 pricing. I'm going to buy stuff at the bottom pricing now. There will be someone in the market that will sell at below market to me. Those opportunities exist. And when you can buy those opportunities and you find those opportunities, you can buy now because you're buying at 2025 bottom pricing. And so you can afford to hold. If things get a little bit worse, it's okay. Your ARV might have to adjust down a little bit, but that's okay. As long as you're not losing gobs of money and you're getting cash flow, you're going to be in a good position. So, yeah. Happy to always lend an ear and speak what I have to share. Thank you everyone for watching. I appreciate everyone who's come on here. Please just hit the like button for me and jump in the comments after. If you're watching the replay, it'd be really cool if you hit the subscribe button. If you're not subscribed already, you probably are already subscribed. So if you are, hit the notification bell so that you can get notified when I drop videos in the future. And yeah, remember the secret to unlocking a wealthier you is 3 levers and control your financial future. You got to, in this order, if you're just getting started, spend less, earn more, and then maximize returns on that difference. So it's all about strategies to spend less, to earn more, to maximize the returns. Look at that beautiful pool. Crystal clear now compared to what it was. Just beautiful, guys. A big old garage over there. There's the house. Have a good night, everyone. We'll see you next week.